So here we are, the Naked Trading webinar. Glad to have you here. Welcome to all the traders here and also those who are watching the recording, of course. Thank you for attending the Naked Trading webinar. My name is Walter Peters. I'm a full-time trader, psychologist, wrote the book Naked Forex. A lot of my strategies are there. We're actually writing another book now. We're just getting the stats all set for those systems in the new book. So that's kind of exciting. And what we're going to talk about today is interesting. This is the I guess you would say like the beginner's course, like, you know, how to get started as a naked trader, I suppose. So let's start with this right here is a buy setup, by the way. This was a buy at 70 and it's at 99 right now on the Euro Kiwi. The reason I didn't take it was because for targeting up here at 61.80, 61.75. The reason I didn't take it is because I just don't like getting into trades the day before non-farm payroll. Maybe that's a mistake. Maybe I should revisit that because the non-farm payroll is definitely not what it used to be. But let's start from scratch. Let's find a chart. I kind of don't want to use the euro just because it's so boring. Which pair should we use? Anyone have any ideas? Shall we go with something exotic like the USD Hong Kong dollar, or something a little bit more middling like the euro yen or something? Let's try the euro yen. So what we're going to do is we're going to build a trading strategy from the beginning. Like, you know, how do we approach trading, I guess is the question. You know, what should we do? If you have no idea what you're doing and you're just getting started and you think, you know what, I like trading without indicators. It makes a lot of sense to me to not have a lagging indicator on my chart. Then that's what we're talking about today. So let's talk about, it's amazing to me that the gap never closed last week. That's really interesting because that means it might not close for a long, long time. So here we are on the weekly chart, and I'm going to trade the daily chart. Let's say I have a job. I've got a lot of commitments, so I don't really want to sit in front of the charts for 4 hours a day or whatever outside of my job. So what I'll do instead is I'll throw up these jiggly lines, which is simply the weekly euro yen chart. And what I'm doing now is I'm drawing these lines on here, these horizontal levels, where I see obvious support or resistance. So you can see support, 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 resistance, resistance, resistance. It was resistance again. It broke through, came back down, and once it broke through, it came back up and retouched it here, which is a very common move. You see it did again, that same thing here. It broke through, came back up and retouched it there. My friend Dennis, that's his whole trading system. That's it right there. Breaks through support, comes back up, touches it as resistance, and he sells off of that. Now, I don't know. He might have been stopped out on that move up. Yep, he would have been stopped out on that move up most likely. But that's the way that he trades. So there, and you know, people who trade like that, that means you're in good company. You know, you come from a long line of traders who trade that way. There are a lot of traders who trade in, you know, the method that I just showed you and derivatives of that, basically. All right. Don't let anyone tell you that hedge funds only do this or pro traders only do that. That's a really limiting belief to say that all hedge funds do this or all hedge funds do that. You know, it's like, you know, like saying all smart people do this or all smart people do that. You know, it's just not, it's not true. It's not true. So you get to trade any way you want. And let's say you have a job, as a person with a job, it makes a lot of sense to trade the daily charts because there's not a lot of babysitting involved. Also, if you have addictive tendencies and you know who you are, then that's another reason to not trade the lower time frame charts, because you don't want to activate your nucleus accumbens. Because that's such a fancy word, I'm going to write it up on the screen. So nucleus accumbens is that area of your brain that's activated during sex, when you take drugs, when you're gambling. There's actually a Parkinson's drug for people with Parkinson's disease, which is a horrible disease, but that drug makes you become like a crazy gambler, which is weird. And the reason why is it's activating this area of your brain. So, these sorts of things all play into your decision as a trader to trade naked, and you want to trade the daily chart. So we're going to go ahead and put all these zones up here. And remember, this is the weekly chart. So as soon as I go down to the daily chart, they're going to be much further spaced apart. Okay. I know we've got several that are really close, but even though they look like they're close, that's 200 pips. And then they're all about 200 pips in this little area right here apart. Okay. So now I'm going to go to the daily, and now I'm going to back it up, and now we're going to see where we're at. Okay. So there are some opportunities here to draw some more, most likely here. Yes. And then also I think there's going to be some in here. Well, certainly there, and then certainly here. All right. So that's step one. When I'm getting started as a naked trader, the first thing I need to do is draw my support and resistance zones in there. And the way that I do that is I go to the higher time frame. Everyone cool on that? Does that make sense? All good with that? Awesome. All right. Now, the other thing, okay, so that's the first part, is you get your support and resistance levels in. And as a naked trader, what I do is I wait for the market to, and you can see what is happening on the euro yen right now. The euro yen is fast approaching the 123.33 zone. Now, if you look at my actual euro yen chart that I use every day, that's this one right here, it's at 123.43. Okay, so I've got my zone drawn at 123.43, and I got my little down arrow there. Not because I'm going to sell when it hits there, but I might. The reason why that down arrow is there is because I have to be alert. Now, what did I actually draw in here? Thanks, Kim. What did I draw in here? I drew at 123.33. So it was a 10 pip difference. Does that mean that one chart is right and the other one's wrong? No. Does that mean that if I drew it at 43 that I missed it when I drew it at 33? No. Because these levels are like big fat beer bellies, okay? Where does the beer belly start and where does the beer belly end? If you've ever been like in a like an amusement park or something, or some crowded place, like a concert or something, and your hand kind of like you're in the crowd and you accidentally push somebody. Or you push off of somebody, or you bump into somebody. And let's say your hand bumps into somebody and this person has a big beer belly. Well, some people, when they touch the beer belly, their hand is actually gonna push into the beer belly before they realize what's going on, because they're distracted, they're dancing or talking to their friend or whatever, and then they pull their hand away from the beer belly, right? And some people won't do that. Some people will, as soon as they touch somebody, they just pull it away real quickly. Oh, so sorry, or whatever. And that's kind of like what these zones are like. So even though I know that we're in the vicinity, we've peaked out at 123.20 on the euro yen, we may see a reason to sell when it gets up there and goes another 20 pips or so. And if that's the case, maybe I will take that trade. But here's the thing. As a naked trader, I first identify my sweet spots where I'm thinking, okay, yeah, I'm going to take a trade. These are the spots I'll take a trade. I know Kim is following me. Yep. So, and then I wait and see where's the clue. What kind of clue do I get? So number one, higher time frame support and resistance zones. Okay. Number two, is wait. I wait for the market to hit these zones. And number three is do I get a catalyst? Catalyst, I think it's catalyst. Yeah. Now I know catalyst because I know the term catalyst because, as a surfer, when I was younger, and I didn't care about brain cells so much, I would fix my own surfboards. And the way you fix a surfboard is with fiberglass and resin. And so if you get a damaged, they call it a ding, if you ding your board, you need to put resin and fiberglass. You need to put fiberglass on the part that's been destroyed, your ding on your board. And then you need to put some resin in there. But you just can't pour resin on the fiberglass because it'll be really sticky. You want it to harden, and the way that you get it to harden is you put a few drops of catalyst in there and you mix it up with the resin. That's what makes the catalyst, or that's what makes the resin go hard. And then you have a few minutes to kind of pour it on there. You could put it in the sun or whatever, and then the sun works as a catalyst too sometimes, depending on the resin, and it hardens. So it's really, it will just stay sticky for a long, long time if you don't use a catalyst. The same thing here. If I just take a trade solely because the market and decide that I'm going to sell here, simply because the market's coming up to a support and resistance zone, I don't know that it's gonna reverse here. I don't know. It could come up here, sit here for a while, and then break higher. Okay? And so that's why number 3 is so critical. People sometimes think that support and resistance trading means waiting for the market to approach a support and resistance zone and then just going, oh, it's here now, time to take a trade. No, it's really more about what the market does when it gets there more than anything else. It's not where the market is on the chart. It's where the market is on the chart, and then what does it do when it gets to that part of the chart. That's really what naked trading is all about. And so I want to just be really clear on this because I think sometimes people have misconceptions about what naked trading is. And to me, naked trading is all about finding the sweet spots on the chart and then waiting for the patterns. Okay. Now, I will admit that it's going to be easier for you to do some sorts of trades and not others. What do I mean by that? I'm going to give you a quick test. Okay. I'm going to do a quick test here. I'll tell you what we'll do is we'll get the pound CAD here. Okay. This is the pound CAD weekly chart. Now what I want, it's actually a horrible chart. Let's use a different one. Okay, let's use a different chart. This chart's awful. It's not a good example of what I'm looking for. So okay. All right, let's do this one. This is the New Zealand dollar. Okay. Actually, you know what I'm going to do? I'm going to kind of move this. I'm going to move this off, and I don't want you guys to see it. The only reason I do that is because I don't want to mess with I don't want to make this too easy on you. Okay. Let's say that you're watching the chart here, okay? And you see the market's going up, pause, up, retrace, up, pause. I want you to be completely honest with yourself. And when you see this chart right here, when you see what's going on right here, do you think that you would be more likely to buy a market that's doing this or sell it? What would, all things being equal, and I'm not talking about the specific candle patterns here. I'm just talking about the general pattern of the markets going up, pause, up, retrace, up, pause. Do you would you wait and look for a signal that says keep going higher and buy, or would you be looking for a signal that says sell? And you can type that in the chat box right now if you'd like, or just write it down. The reason why I'm asking you this is because if you're honest with yourself right here, this is going to really help you hone in on the style of trading that you should do. It will. Everyone got that? Okay, cool. So let's do another one. And again, I'm going to pull my chart away here so that you don't see what's... Okay. Okay. So here's another chart right here. You can see the market's been going down, pause, down, pause, down. Seeing this chart right here, as you do right now, would you be more likely to look for a trade, a signal, a reason to buy this market or to sell it? And really, this is your gut reaction. There should be no thinking involved. It should just be, oh yeah, I'd be looking for a sell here. Or, oh yeah, I'd be looking for a buy. All right? Please write that down right now. And that's a really important thing. Okay? So we've got two. We've done two questions, and we're finally going to do one. We're going to do another one. Let's see. I'll get another one for you. Again, I like to take it off the screen because I don't want you to know kind of what's going on, you know? Okay, here's another one. Okay, here's another one here. Seeing this chart right here, you know, and I could even, if I wanted to, I could even like draw a box around, you know, the recent movements, something like that maybe. Seeing this chart right here, would you be more likely to look for a reason to buy or to sell? So seeing that, you know, the market's kind of consolidating, it's made a low here a few times, it's made a high up here a few times, and it's kind of up there again near that high. Do you think you would look at this chart and say, yeah, I think I'd be looking for a signal to buy here? Or would you be looking for a reason to sell? And again, your gut reaction is going to be the best thing here for you to operate with. All right. So what we've just done is we've done a quick and dirty test. And the first one that we looked at was an uptrend. And if you were looking to buy there, then you're most likely a trend trader and you're okay taking bullish trends. The second one we were looking at was a seller's market, a bear trend. In the first one, in that first example, if you were looking to sell, you're more likely a swing trader. You're looking for turning points in the market, right? So when we had that first uptrend that we looked at, if you decided, yeah, I'd like to sell there, you're more likely a swing trader. So you like to find swing points. And if you were looking for a reason to buy, or you're thinking about finding a reason to buy, then you're a trend trader. You like to go with the trend. Now, the second one we showed was the same thing. It was a downtrend. And if you were looking for a reason to sell, you're more likely a trend trader, and you're okay trading downtrends, bearish trends. Because the reason why it's important to look at both is because some people, like I prefer to take seller, I'll take both, but my preference is to sell. I don't know why I have this preference that it's easier for me to see a sell setup than a buy one. I feel like, I don't know, gravity's going to help me or something ridiculous like that. But it's true. And I find myself, I'm more easily convinced to take a sell trade than a buy trade. No doubt. And some people aren't that way. They're the opposite. So that's why we had that second one. And again, if you were looking for a reason to sell off that second chart that we looked at, then you're more likely a trend trader and you're okay taking bearish trend setups. If you were instead looking for a possible buy setup, then you're more likely a swing trader, okay? Because that was a bearish move down. The market was going down, down, down. Now let's talk about this current one. The current one here is a consolidating market. If you would be sitting here looking at this chart thinking you'd be loved to see a reason to buy, then you like breakouts. You like trading breakouts when the market kind of coils up, gets really quiet, and then all of a sudden just breaks out and goes crazy. So the pound has been kind of like that lately, where it's been coiled up and then it's getting ready to go crazy. If, however, you were looking for a reason to sell up here, then you're okay playing consolidations, which I think is crazy. I think it takes a special type of trader to do that. You could argue that you're a swing trader, but really swing traders look for more easier pickings than trying to trade the edges of a consolidation area. But trading consolidations is another way to do it. A lot of traders that trade the Asian market during the the low volatility time of the day, they're okay with that. Like they might pick off a few pips here or there, and they're just looking for consolidation, looking for the market to get rejected off of a zone or something like that. So that's another way to do it. So you're either a swing trader, a trend trader. You might have a bullish bias or a bearish bias, depending on your answers to the questions that we went through. And then you could be a breakout trader, or even like a reversion to the mean or a consolidation trader, which would be the kind of trader that would be looking to sell when the market gets up here. Up here, you're looking to sell. Down here, you're looking to buy, these kinds of setups, right? If you trade channels, you could do that too. But, you could say that you're a swing trader, but really, swing trading to me is a lot easier when you have more wide open space. And you never have wide open space when you're talking about a channel or a consolidation range. You just don't have it. The market gets really choppy. And that's why you see it's never like a straight shot from one end of the edge to the other, or rarely does the market go up to the top and then fall straight down to the bottom. That's pretty rare. It usually kind of takes a haphazard way like this, and kind of chops around and goes up and then down and then up, and then down, down, up, like that. It's just it's not really a direct shot. So those are the styles of trading. Now, why is that important to know what kind? Well, because listen, some people will tell you, to do good at this, all you need to do is find somebody who makes money and you just copy what they do. That's completely wrong. What you need to do is find somebody who trades in a way that resonates with your style, and then what you do is you modify their trading style to fit your beliefs. So if you like the idea of trading kangaroo tails, but you're a trend trader, you only take trendy kangaroo tails. And if you like the idea of trading breakouts, but you only take channel breakouts, then maybe you take them in the direction of the trend because you like taking breakouts with a clear direction, So you might trade channel breakouts. Or you like big shadows and you like trading with the trend, you might trade big shadows after a consolidation with the trend. Or if you like trading with the trend, you might like to trade these pinch trades, which is basically what we're looking at right here. See how the market broke out of this consolidation here, went up, came back down, and it looks like it's bounced off this support level. That's a trade right there. Like I said, like it's traded higher than the high yesterday already. It's traded as high as 59.02. So it's made that move up off of this bounce here, or potential bounce here. So is this making sense to everyone? So if you're going to do this, if you want to trade naked, those are the steps that you would take. So I use the higher time frames to draw my zones. I wait for the market to get there, and then I decide if I have a catalyst. Now, the catalyst that you'd be looking for, the breakout trader, when the market gets here, is looking for a reason to buy when the market reaches resistance. This is a support and resistance zone, and we're on the resistance side of it because we're below it, right? So the breakout trader is looking for, if the market kind of sits here and consolidates at this level, the breakout trader would be waiting for a breakout. The trend trader would also be waiting for a reason to trade if it breaks higher, or if it retraces and then gives an exhaustion signal at the end of the retracement, something like that. The swing trader will be looking for a sign of a reversal here. Okay? So, everyone kind of has an opportunity to trade it. Like if it gets up here and it consolidates, let's see, where's the pound? Like with the pound, to me, this is a really ugly chart. I don't like trading it when it's like this. But with the pound, there are some people that are making lots of money here because what are they doing? Well, they're trading the bounces. They're trading the bounces off the edge of the box. The lower limit was the lower edge of the box was defined here, and then potentially here. The upper limit was defined here, there, and there. So, we have 2 touches here. We have 2 touches here. So the market comes back up here, we sell. The market comes back down here, we buy. Now, it probably would have been stopped out because it stabbed so low here. But this could have been a buy down here. So, depending on how you look at it, this could be an awesome opportunity for a 1-hour pound trader who likes to trade consolidation boxes and likes to nibble at the edges. But if you're a trend trader, I can't really see how you would look at this and get ready. There's really, to me, there's no signal yet. There could be a signal soon, but there is no signal on the daily chart. Now, some traders would have been looking at this, and they say it's already broken out to the upside. So they're already in, okay? And their stop might be down here below this candle, for example. But to me, it hasn't really shown yet what it's going to do. And look at all this support right here. So that's kind of where we're stuck. We're kind of stuck right here. Now, let's talk about how to interpret price action when it sits there on a zone. How do you know if it's going to break out or if it's going to reverse? Apologize, everyone. Can everyone hear me okay? I hope that the sound is okay and everything's okay. Sorry if there's a technical issue. But it seems pretty good to me. My internet connection's fine, so hopefully it's all right. Probably the webinar has stopped out. Okay. Well, I'm just going to keep going for the recording. So maybe we'll have people watching the recording here. So the question that comes up here, I don't know if it's been reconnected or whatever, but I'm just going to keep going and we'll have it on the recording. So the important thing here that I want to point out, guys, is this. When the market reaches a support and resistance level, like the euro yen is right now, like the pound is right now, there are some clues that you can use. Now, number one thing we need to pay attention to is, what are your beliefs? What do you believe? What do you believe about trading? Do you believe that you can simply okay. All right, cool. Okay, cool. So if you believe that right, okay, cool. I'll just keep going. All right. When you see this the market reach a resistance level like this, are you the type of trader that believes that, you know what? It's probably I'm going to be looking for a reason to take a reversal here. I'm a swing trader. I'm looking for a sign of a swing point. Then that's what you need to do. You need to focus in on that. You don't have to trade both ways. Wait until you have more experience to do that, to be able to put on different hats. It's so much easier to just define yourself early, get really good at that, and then expand. But that's kind of obvious, I think. I think some people feel like they need to be well-rounded or whatever. But I'll tell you this much. When the market gets to these levels, like the euro pound or the euro yen and the pound right here, it will throw some clues up for you. The clues that are showing right now for the pound suggest that the pound will trade higher. Here we are. This is the May 4th daily candle, 2017. And it hasn't closed yet, so I don't know. But just by looking at the last 4 days, the fact that we spent 4 days sitting right here on this level suggests to me that we are going to break higher. We're just consolidating, we're just resting, and it will break higher. The fact that the market found resistance 3 times here before falling lower, and actually this is the first time if you look at the weekly, this is the first time the market's come back up to this level. So I'll show you all the clues here. Number 1, we rammed up to this level with this big bullish candle. That's clue number 1. Clue number 2, we consolidated. This is a classic trend consolidation pattern. And number 3 is that we have multiple candles sitting right on the other side of the zone. Whenever you have several candles that keep touching, and when I say touch, I mean they wick into, or the body or the wick hits that zone, the last 4 candles, and we don't know what's going to happen today because the London session is only just starting, but the fact that 4 of the last 5 candles, and again, today we don't even know because we're only 2/3 through the day, but the fact that these candles have been sitting right here, and look at the line chart, it could be a double top, right? But the odds are actually in favor of a breakout here. And the reason why the odds are in the favor of breakout is because the market did not come up here and touch it with one candle, and then the next candle was an immediate big bearish candle. And that's usually what you see when the market gets to a level if it's going to reverse. I'll show you. And this is going to be clear on the line chart. See this right here? This is an awesome rejection because of how sharp the line chart shows. See? So what that means is we came down here and then boom, it went really strong away from that level. So it didn't want to break through that. It wanted to reverse. This is another one here. You can see you got 1 candle, 2 candles. Well, maybe even you could count 4. But then look, it went away from it really quickly. So once you see this, you think, oh, okay, maybe it will double top, and then if it double tops, I can sell. It did, and you can sell right here. See? It hits it, pulls away, hits it again. So at worst case, when the market hits something and moves away from it quickly, it might come up and hit it again and double top or double bottom and then move away quickly. When I say move away quickly, I mean big bearish candles have to start lining up. Now, contrast that line chart here with the sharp move down. Now, it really, ideally, it wouldn't even have a flat thing here. It would just sharply move without because that means it closed 1 candle on the level. You know what I mean? But if it didn't close 1, and if it reversed, that would be much, much better. If it didn't have that extra close in there, which is basically this candle right here. If it went up there with this candle and then immediately started printing bearish candles, that's even better. Now contrast this move here to this one here. See how the market's just sitting here, sitting here, sitting here, sitting here. Finally it broke. That's kind of what we have here. The market's sitting here, sitting here, sitting here, sitting here. Finally it's going to break. This could be a double top, but I don't think so. And the reason why is because the best double tops don't immediately come back up and touch the zone. The best double tops are like the ones that the one we just saw over here, where the market hits it, spends several candles away from it, and then hits it again, and then that's off and it's over. Those are the best double tops. And then the best breakouts, what typically happens is the market hits it, might go a little bit away, hit it again, 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 and then finally break. This is a classic breakout pattern. So hopefully everyone can see that. It's really important that you understand the difference between the market hitting a level and then moving. Like, look how sharp this one's going to look. This is going to be crazy. Look at that, how sharp that line is. I mean, that's kind of excessive, really. But the ones like a normal one would be something like that. Like this, when you see this on the line chart, that's where swing traders come in and the reversal traders. They say, yep, I'm in on this. I want to short it here. I'm just assuming that there's a zone here, guys. I'm just looking at the candles here. I'm not actually looking at the zones. Obviously, you need them to hit the support and resistance zone first, right? Okay. And then it falls. Okay. But if you see it get to a level and it just kind of sits there, it's more likely to break. So it's when it sits on a level, it will usually flatline on the like this. So let's say we had a zone right here, right? Okay. So what is it doing? It hit it, hit it, hit it, hit it, hit it, hit it. Finally, it broke here. Now, it didn't break for long. It was more of a false breakout. But the point is, you don't really want to short it here. Not at this stage when you see 1, 2, 3. Quadruple tops aren't really a very good naked pattern. Double tops are pretty good. Triple tops, I think, stink. But 3 and 4, 5 touches, those are breakout patterns. They're not reversal patterns. So here's another example right here where you see, wait, I kind of messed that up. Let me show you. All right, so here's the classic double bottom because what? Sharp, move away, spend some time away, comes back down and hits it again. That's what your double bottom looks like. Whereas your breakthrough or your breakout pattern, it's going to be something like, really it's going to be something like this. See how it's just boom, bam, 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 boom, finally breaks out, retouches it, and then goes higher. Kind of double bottomed on the retouch, but that's, that'll happen too sometimes. The point is, if you see a flat, where it keeps hitting it over and over again. So like, let's say you have 10 candles, and of those 10 candles, 6 of them keep hitting your support or resistance level. That's a sign that it's going to break out. If you have 10 candles and only 4 of them have touched the level and it's moved away quickly and you see these really sharp lines down, it's more likely that it's going to fall away from that level. Now, it's not perfect. You can see here what happened is we have this would be a really nice, assuming that we had a zone here. Now, I don't know that we did, but let's just say we had a zone here, okay? This would be a really nice double top looking formation. A really nice one. Now it only has 2 candles between the touches, but still that's enough. I mean, ideally it's 5 to 20, but so that would be the only problem I'd have with this. But just looking at the line chart, I go, yeah, I want to sell here. I want to sell below this low. What's interesting is it does slightly go lower, but my guess would be that would have happened during Monday, and I never take my weekly trades on a Monday. This low was almost certainly made on a Monday. In fact, well, shall we see? Let's see. September 2006. Let's see. Because now I'm curious. Oh, what did I do that for? I can't believe I just did that. Oh, I can't believe I just did that. I completely ruined my chart. Oh, that's funny. Okay, where is my pound? I'm gonna do a new one. I'm just gonna do a new one. Okay. Oh, that's so funny that I did that. But what we had was the September 6, 2006. Now I just want to show you because I'm almost I'm not certain, but I would be shocked if it was not a Monday move that did that. Let's see. Let's just see if I'm right. September. Oh, it's right here. Okay. Yeah. So on the weekly, yeah, so this is the move right here. Okay. All right, so this is the 10th. Okay. This is the September 8th, and this is September 11th, 2006. And that's Monday. So this is Monday, Tuesday, Wednesday, Thursday, Friday. Friday the 15th, and then that's Monday the 18th. Yep. So what we see here, if you zoom in, is this is the end of that first week, the move down on the weekly chart that we were looking at before. And this low right here of the week was made on Monday. extremely normal that you would have a low or a high of the week made on Monday. Incredibly normal. Unbelievably normal. It's not perfect, but by waiting for the market to break the low that was established on Monday, I would have avoided that dicey double top. It looked great, but it didn't work out. And by just using a simple rule of, waiting for the market to penetrate that low, and not on a Monday. I usually go Tuesday. London Open is when my trading week starts. So anyway, that's a good example of that. Now, let's just recap what we've talked about here, because I think this is important. Number one, if you're going to trade naked, you need to draw your zones, and that's really where you're going to wait. You're going to wait for the market to hit those zones. You should use the higher time frame for a number of reasons. The very best zones are going to pop up on the higher time frame. Number one. Number two is you don't want too many zones. If you have too many zones on your chart, then if the market's hitting a zone every single day on the daily charts, they're too close. As a general guide, I would expect it on most pairs, like the pound, for example, maybe my zones are about 150, 200 pips apart on average. Some will be 300 pips apart. Some will be 400 pips apart. Some will be 110. But generally speaking, you're looking at about 150, 200 pips apart, okay, as just a guideline. Obviously, that's not a perfect, like we've got one here. We've got one here. And then there's going to be one somewhere in the middle about there. Okay, so what's the distance between these? That's 500 pips. That's 600 pips. This is a weekly, though. There's another one there. And then now it's going to get really, see how there's like a big gap there. But then when I go to the daily, I can go, well, that's pretty good. But look, I missed one here. There's this gap here between... This is 780 pips, but guess what? I probably should have had one here, and maybe I should have had one around here, right? So you can kind of fill them in on the time frame you're trading. But the point is you definitely don't want to have like boom. Your chart shouldn't look like like a highway. If your chart looks like this, you're in big trouble. Okay. The only time your chart should look like that is when you have like a 1 hour chart with 1 hour zones and you accidentally hit the daily button. So now you're looking at the daily, you know what I mean? Then it'll look like that. But otherwise, and it's a common mistake. I mean, you laugh or whatever, but it actually happens. So, okay. Cool. All right. So now, all right. So let's just recap here. I want to make sure everyone's clear on everything. You wait. I draw my zones. I make sure that they're all right. So I draw them on the higher time frame on the weekly. Going down to my daily. Make sure I draw in the ones on the daily that I missed. Then I wait. I wait for the market to get there. I establish, who am I? Am I a trend trader? Okay, then I'm waiting for a pullback and the end of the pullback, and I get in at the end of the pullback. If I'm a breakout trader, I wait for the sign of the breakout. It could be a breakout and a retouch, like the pinch trade that I showed you, my friend Dennis does, or it could be a last kiss trade, or it could be a first touch trade, or whatever. There's lots of different ways to do it. But the point is, I'm just looking for that quiet market, and then once it gets quiet, I get excited because then I know it's going to break out. You also could trade a breakout when the market's trending and it's just sitting on a zone. You see it's not giving you a double top or a really sharp bounce away from it. It's just kind of sitting there like we were talking about on the euro yen. Sorry, on the pound right now, not the euro yen. The pound right now, which of course is this chart, so we'll zoom in on that. Because it's just sitting there and spending so much time right up against that zone, I know that it's quite likely that we're going to break it. It's quite likely that it's going to break higher. It could pull away from here. It could certainly do that. But the fact that it's just boom, boom, boom hitting it, and it had this real bullish candle before, it's probably going to break higher. Yeah, we'll see. We got non-farm payroll tomorrow. We'll see what happens. But this is more often than not a reversal. It's more often than not a trend continuation. And I'm not even counting today's candle because it hasn't closed yet. I'm counting everything like up to there. That's what I'm looking at. All right. So we know who we are. We know the style of trading we want to trade, whether we're reversal traders, swing traders, breakout traders, consolidation traders, trend traders, whatever it is. We know who we are, so we've defined ourselves. And then we wait for the market to get to those zones, and we wait for those patterns. Now, typically what you'll do as a naked trader is you will establish yourself as whatever type of trader you are based on your testing. So I like to use Forex Tester. If you want a discount copy, I have a link here, fxjake.com/tester. It's awesome. I don't know any traders who make a living at this who haven't spent hours upon hours and gigabytes upon gigabytes of, testing in Forex Tester. I'll give you a hint. Try and break it up. Sitting there for 3 hours and growing a beard while you're doing Forex Tester, that's not a good idea. Doing Forex Tester and then taking a break every 15 minutes to go do push-ups or, drink a green smoothie or go say hi to your friend or go play mahjong or online or whatever, do some online gambling or whatever. I don't know what you do, but the point is breaking it up is going to help you out quite a bit, actually, because what you'll find is if you don't break it up, your first trades are really vigilant. You're really vigilant in the beginning. You're really good. They stick to the system, letter of the law, and then boom, at the end, they just completely fall apart. So breaking it up is a smart thing to do. This is an affiliate link in all, being very transparent here. So I do make a little bit if you click on my link and buy it through me, but you'll also save like $50 if you buy it through me too. So it's a good deal to get it if you don't have it. So once you know what kind of system, you like to trade, if it's a trend continuation and you have your numbers, you've got your risk set, you know what kind of risk you should be doing. The one question you should ask yourself, and here I'll give you another link. This is a free tool for you. Go to fxjake.com/risk, plug in your numbers, find out how you can avoid, or most likely, nothing's guaranteed. How do you likely avoid the drawdown? So let's say I don't want to hit a 20% drawdown. So I plug in my numbers. I know what my win rate is, my average winner, my average loser. I plug all that stuff in, and it tells me that I should risk 1.2%, and I'll be very, very unlikely to hit a 20% drawdown. So I know I can risk up to 1.2%, that sort of thing. This is how, pros go about this. So I hope this has been really helpful for you guys. I'll, if you want to look at any charts, we can definitely do that. But I just wanted to make sure that, we had at least one webinar here where we go straight from the beginning, from the basics. So I'll tell you, I don't really have a whole lot of, the ones that I probably are most interested in right now are the Swissy. If it breaks through this zone right here, I think it could all go all the way up to this trend line right here, but it's got to clearly break through this zone. Ideally break through, come back down and bounce off it with a bullish candle. That's on the daily chart. The other one that I really like is the CAD yen, which is here. No, that's the 4 hour. Let's see if I can find the CAD yen on the daily. There it is. There it is. So similar setup to the Swissy. That's the other one I'm watching really carefully. After the non-farm parallel, we'll see if we break higher, come back down there, bounce, and then I can trade it all the way up to this trend line. I'll probably put my stop loss below the bounce candle if it's a big one, or if it's a really small one, I'll probably put it under this low right here. My stop loss would be down there. So that, that could be a risk of 140 pips. But, 140 pips to make 280 is pretty good, right? That's 2 to 1. So those are the kinds of, those are the ones that I'm watching right now. Yeah, basically it. Okay. All right, guys, I really appreciate your time. I hope you have a wonderful trading week. Thank you so much for all your time. We will see you soon. Take care, guys. Bye. See you. Thank you. Thanks. Bye. Hope to see you in the forum as well. Yeah, it's nakedforexnow.com. See ya. Bye.